Welcome to It's the Economy. The all-important US FOMC meeting starts today and the rate hike decision is expected tomorrow. Most economists are expecting a 75 basis hike, but after the August CPI in the United States came in a tad above expectation, about 16% have veered to a 100 basis rate hike forecast. What impact will this have on the Reserve Bank's decision at the MPC meeting scheduled next week? Is the rupee in danger of more depreciation from the Fed's liquidity tightening? But more importantly, are foreign investors more favorably disposed towards Indian bonds, Indian equities and investing in India due to the losses they have suffered in Russia and in China? For all these and more, we have with us Hitendra Dave, Chief Executive Officer, HSBC India, a veteran Indian banker. Good morning, Hitendra. Thank you very much indeed for joining us. I think you have touch points with more foreign investors, both FDI and FPI, than anyone I know. So tell us about this pro-India wind that seems to be blowing. Is it true? Is it in both portfolio and FDI?
Yeah, morning, Lata, and thank you for inviting me. I think to answer the question that you are asking me, I think you really need to have a relative comparison, right? You look around the world, if you have a pool of liquidity or a pool of capital to deploy, you're a sovereign wealth fund, you're a large pension fund, or you're a very large company with tremendous amount of surpluses that have got generated in the last 3, 4, 5 years. And then you take a look as to where you want to deploy that capital, and you go, geography by geography. You look at Europe with the challenges that it is experiencing on account of the war, on account of energy security, on account of energy availability and energy pricing. There are stories of many factories will need to actually shut down because of lack of available energy resources. You look at UK with its, the new government has obviously done something to cap prices, but clearly it's still double of what it used to be earlier. You look at China and all the challenges which are emerging there on account of the zero COVID policy and its real estate challenges. And then you look at, maybe South America, and again you see the kind of political and economic stability that is there in India, which is reflected in the GDP numbers, which is reflected in the bank NPA numbers, which is reflected in a lot of data points that we track. So yes, the answer is, I think if you're an investor sitting in any other part of the world and looking to deploy your capital, India is not just looking good, it is looking absolutely brilliant when it comes compared to any other part of the world. And then on an absolute or internal basis itself, yes, we are unhappy that the rate of growth this year might dip below 7, but compare that to the rest of the world. You look at what's happening in the banking industry in terms of the NPAs and credit growth. You look at what's happening in the real economy in terms of, I think in the previous session I overheard some conversations about the kind of retail demand that is expected in this festive season. I'm told the 4-day break that we had in middle of August, the 15th August weekend, again had tremendous outcomes. So yes, net, I think it's looking really good. And the second thing I would want to add is that the optimism in my conversations with industry leaders, captains, everyone, I don't think I have felt this level of optimism as I hear today from the people who make core investment decisions. So it's a good narrative to be in. Okay.
Thanks for that. Great start to the conversation. But, let me first look at only the portfolio guys, because the first thing that cash-rich treasuries would do is to park it in, stock markets. That's easier than FDI. Do you think valuations will start becoming a worry?
You see, naturally, you look at our stock market, it is up for the year, right? Despite all the challenges that all of us have spoken about, inflation, oil,
for the year.
Currency, trade deficit, etc. Yeah, so it's up for the year. And if you look at a slightly longer term, right? I think it's time for us to start actually talking about the fact that over a 10-year period, over a post-COVID period, India has done much better than much bigger markets. So I think it's time to call out a little bit that perhaps there is some underlying change in the Indian economy, some underlying change in governance, some underlying change in the cash flows of Indian corporates, of the banking sector, for example, where you get the sense that my earlier response was largely reflecting this part, that if you have to put money into stock markets where the economy is doing well, corporate sector is doing well, consumer health is well, government revenues are good, bank balance sheets are good, household balance sheets are good, I think it's ticking so many boxes. And I suspect some of that is at play after having exited in hordes well up to the middle of this year or so, you can clearly see a bit of reversal because the adverse outcomes that were possibly anticipated have not happened, and on the other hand, more positive developments have happened.
Okay, now let me come to bonds. The expectation that India will be included in the global bond indexes has had generated a rally, but it is still toss of a coin. If it didn't happen in the upcoming meet in a few weeks, will there be severe reverses?
I've had a bit of a disconnect on this whole story that goes around twice a year, every year. Every time somebody wants to justify why the bonds have rallied, it is attributed to the bond inflation story. And every time somebody wants to justify why the bonds haven't rallied, it is because the index inclusion story hasn't come true. I think if you look at the structure, the microstructure of the bond market, and there is a reason, right, why despite such a large increase in supply, despite what the Fed has done, despite what the pressure on the currency has been, bonds have, they're down 50 basis points, which is a very large amount in bonds per se, but you would think that was already penciled in, right? So I think there is something to be said about long end bonds being taken out by the pension funds and the insurers, etc. And there is also something to be said about the fact that I think bank ALMs have largely underinvested during the very low periods of 2020 and 21, and that is getting redeployed now. Index inclusion, if it were to happen, clearly it will generate sufficient flows. But at this juncture, there is nothing credible that I have read or seen or heard. It's just stories in media, and therefore, if you go by that, it's very difficult to trade your positions.
I'm extremely glad that you put that on the table because the market was almost veering towards one side, purely going by brokerage reports. And it is important to remember these are only brokerage reports, and nothing has come from the horse's mouth. Okay, Hitendra, all this conversation was to veer around to the rupee. There is a problem in the current account deficit, although the Reserve Bank says it will be under 3%. Every economist, including pseudo-economists like yours truly, are calculating CAD at, 3.5%. So, do you think that the rupee is game for more pressure? I mean, 81 perhaps.
No, I think I'd just like to step back a little bit, right? I mean, and therefore you see the currency movement not just in the last 3 or so, but in a slightly broader context. If we go back, let's say 4 years, September 18, I think India's FX reserves were about $450 billion, absolute, right? And then you move forward to September 21, India's FX reserves were at about $650 billion, plus there was another estimated $40 billion in the forward book. Now, so this is about what, $240 billion increase in reserves. But if you see the currency movement in these 3 years, it wasn't as you would expect, right? It wasn't allowed to appreciate. So I think that's the context I would want everybody to have, that when the currency should have appreciated quite dramatically because the excess of dollar inflows over outflows was almost $100 billion a year, it wasn't allowed to appreciate. It largely remained stable. In fact, it was an orderly depreciation, a managed depreciation, if I may say so. So therefore, from September 21 now to September 22, when the reserves are down, say, $130 billion, of which, say, $30 odd billion is revaluation, so the real intervention is anywhere between $80 to $90 billion. I think you have to see it in that context. I think the governor said it himself. You buy an umbrella for a rainy day, and so when it rains, if you don't open the umbrella, it's a little pointless to accumulate the reserve. So my own sense is, given everything we've seen in the last 4-5 months, I think there is a sense that RBI is trying to manage the currency level over this 4-5 year period as opposed to just the 5-6 month period. They are saying it would have been whatever, early 60s, mid 60s. It wasn't there, it was kept in the 70s, and therefore even the depreciation should not be just looking at the current data, is my sense. I think everything would seem to suggest that that there is tremendous appetite and willingness to intervene should the market demand dollars. That said, I think the one difference between when RBI generated or mobilized reserves versus what it is using now is that was excess of portfolio flows, right? We never had tremendous amount of surplus on the current account. It was largely balance of payments surpluses on the back of FDI and portfolio flows, while the current deficit is on account of actual dollar demand from the real economy, which is the trade deficit of the current account that you mentioned. So at this juncture, I would say, I think for the rest of the year, I would think 80 should be toppish.
Okay. There is a significant camp in 81 camp as well. Of course, not for keeps, but A shy at 81 is being forecast. Much will depend, of course, on what comes from the US FOMC day after tomorrow, our time, Wednesday evening in the US. What's your sense? If it comes to 100, if in some ways it is more hawkish than the 75 basis the market is prepared for, what can be the fallout?
Yeah, so I think I would be personally quite surprised if it's not 75. I think if it was more than 75, I think they would have telegraphed it by now, and therefore I think the base assumption is 75 in my mind at least. I would also just contextualize that over and above the 75 or the terminal rate, which people are increasingly talking about 4-quarter or so, I just think for all of us as part of the economy, part of the banking system, just part of the people who like to think about these things, is that how long will it stay there? So what's got broken post Jackson Hole, post last CPI is this assumption that Fed will hike fairly quickly and then it'll cut fairly quickly. At least that's gone off the table. And what we will have to really prepare for, it's not about tomorrow's decision or whether it halts at 4 or 4-quarter, but we haven't really seen like a 12-month period where the rates remain that high for going back now 13-14 years or so. I think that will be the key challenge for central banks like India or economic agents, etc., where what happens to people who decide on capital flows? Are they happy to just earn 4% rather than deploy it around the world where it is a higher return or so? But to answer your question directly, if it's 100, which I think is highly, highly unlikely, but if it is 100 basis points, I think there will be significant volatility to provide for on Thursday morning for our time. So I think whether it's bond market, whether it's FX markets, whether it's equity markets, I think all three will get a bit of a shock. And I think that's a low probability, but then if it is 100, that is a very certain outcome that there will be a lot of headlines on Thursday morning.
Well, there is a significant number of people, forget day after tomorrow, forget this week's decision, who believe that the Fed may go all the way to 4% or even higher, Fed funds rate, that is. The Reserve Bank's State of the Economy chapter had a sentence, "Our currency, your problem," as the motto of the Fed. And former central bankers say that, it will be extremely foolish of any EM central banker to not toe the Fed's line when it comes to rate hikes. So, what from the Reserve Bank?
No, so I think, I don't think anybody at Reserve Bank of India would also say that, they are completely ignoring what's happening in the rest of the world. That it doesn't happen in a globalized world where capital flows happen the way they do, etc. I think the good thing for India is that the growth sacrifice that naturally comes along with rate hikes at this juncture seems the economy is strong enough to be able to absorb. I think like I mentioned earlier, the optimism is high, the real data is high, data like power demand, data like railways, goods movements, everything, direct taxes, indirect taxes, everything would seem to suggest that we are in that nice sweet spot where the RBI can focus more on inflation than on the worries about growth at this juncture. Plus, then you juxtapose that with the fact that 75 has become the new 25, so to speak, in the Western economies in terms of rate hikes. So I would think 50. Base case is 50. Why you would not do 50 should be debated, but my guess is 50 is the need of the hour, and then we look forward going into what's happening to our inflation, what happens to our growth, but also what the Fed does and the other central banks do around the world, and then you decide thereafter. But I think with this 50, if it does take place, I think we need to remember that we would have moved from, because we were at reverse repo and we would have taken everything now to repo rate type of thing. The actual movement is almost like 260 odd basis points or whatever the exact number turns out to be, which is as much as any other central bank around the world. So I think that we also need to figure out. And with inflation, which is high by what we want to accept, but lower by what you see around the world. So from a MPC perspective, my guess is 50 is a very, very high probability outcome. Okay. I think with that 50, I think they might even start talking about the fact that a lot of the heavy lifting and front loading has got done. Fair. And start indicating to the market that ceteris paribus, we are close to the terminal rate. Maybe we see what the Fed does, maybe we see what happens to growth and inflation, but the additional hiking might be a much lower amount than what we would have already done, and that's a very good strategy, and I agree with that completely.
Okay. Unfortunately, out of time, Hitendra, we'll invite you again after the policy for more on what lies for India hereafter if the world moves into a recession, or if parts of the world move into a recession. Thank you very much for joining us. Wrap up on Bazaar. Chartbusters up next.